Hey, today we're going to talk about why overbought and oversold levels are losing you a lot of money. They used to lose me a lot of money too, and the whole thing is a joke. It's really, really deceiving, and there's 3 ways to measure it, but only one of them works, and it's not the one you would expect. So I'm going to share that with you here right now. By the way, make sure that you check out the free indicator that I've got for timing your entries. Go on over to indicatorwebinar.com, and I'll share that with you absolutely free. So, overbought, oversold levels. Here's what doesn't work. Any kind of indicator that has an overbought, oversold indication on it is malarkey, baloney, and humbug. There you go. That's my grandpa speak. Okay. So, why is that? That's because those are bounded indicators, things like stochastic, RSI, things like that. And so, an indicator is just a math formula. Let's face it, that's what it is. And so they haven't, the bounded ones, have an artificial floor and an artificial ceiling. And so what that means is that the person who coded it simply put in a line in the equation saying can't go above 100, can't go below 0, therefore it's an artificial floor, meaning it has nothing to do with price action, market movement, momentum, velocity, acceleration, volume, none of that stuff. So, for example, the stochastic. Why can't the stochastic indicator go above 100? Well, just because, well, frankly, George said so. That's it. George said so. That is the story. So, okay, well, in that case, it's not really overbought, is it? So then we could go to another kind of indicator, which is unbounded. So that would be something like MACD, etc. Now, here's the problem with those. Okay, they don't have an artificial floor or ceiling in the math equation, but they're built on moving averages, such as moving average convergence, divergence. So then you've got a gravity effect that you are pulling away from. It's a reversion to the mean to the moving average. So sure, there's no absolute number there that is blocking it from going higher or lower, but you're fighting against the odds, and so, or against the, and really, well, actually, that's pretty good, because that's what this is really all about. Trading is all about statistical advantages, or as we like to say, having an edge, or having the odds on your side. It all comes down to a statistical advantage. So those artificially bounded indicators have, there's no statistics about it being overbought or oversold. And frankly, not so much either with things like MACD that have no artificial floor or ceiling, because you have that gravitational pull, the reversion to the mean dynamic, that energy that always wants to pull it back to that average. The third type of overbought and oversold is much more reliable. So here we are dealing with pure statistics. So thinking of things like average true range or standard deviations. So you get beyond the norm on those things, okay? That is literally measuring a statistical aberration. And now we're talking, okay? Now we're talking with something we can deal about, or we can talk about and deal with when we're talking about getting a statistical advantage or a probability, because the measurement itself is based on probabilities. Okay, but that's not all. Here's another problem. Problem even with those is that even though it's unusual and rare for the market to break above those standard deviations and average true ranges, they still will. And the problem is, how long will that sustain? We could get into what I just call a megatrend, a raging bull market or a raging bear market. And it can stay outside of those standard deviations or average true ranges for a while. And then you're constantly fighting against that move. And when do you fade it? When do you go against it? So now we come to the issue of timing. So we can use those measurements of going beyond a standard deviation or average true range, but then we need to incorporate timing with it as well to determine, okay, when is this thing going to exhaust? Because again, these megatrends can go on for a long time sometimes. Is it the norm? No, but the time you're trading it, that becomes very important. So how do we measure timing as to when the standard deviation extreme is going to end? Well, the best way to do it is with actual market energy, supply, demand, buy, sell, disparity. And so we look for momentum shifts. All right, what's a momentum shift? Momentum shift is where, well, momentum is literally velocity times mass. So the speed of the orders starts slowing down, and the mass of the orders, or the volume, starts to dissipate. When you get that combination, that is literally mathematically what a momentum shift is. And combine that outside the extreme of a statistical probability, or as we've talked about, standard deviations, etc. Now you combine that, now we're talking, now we're cooking with butane, right? Now we got something we can trade and have the odds on our side. And by the way, that's exactly what my timing indicator does for you. Literally shows you momentum shifts. So yeah, head on over to indicatorwebinar.com. I'll spend a hour with you live, by the way, and show you how that works. At least right now they're live. I might turn it into a recording here in the near future, or maybe I'll take it down. I haven't really decided yet. By the way, last little tidbit here. A lot of you don't know this about me, but I've got some Viking in my blood. I gotta actually turn the camera over this way to prove to you. There we go. I got some Viking in my blood. All right, so having said that, and if you're listening to this on podcast, by the way, it doesn't make any sense to you because I'm showing something visual right now. I apologize for that, but you can check it out on YouTube or Facebook if you are really desperate for a ridiculous dad joke to finish up your day. All right, everyone. Well, Barry Burns here, Top Dog Trading, and hope you found that helpful. This is the kind of stuff, by the way, that amateur traders don't bother with, or don't understand, or don't dig into the details. And you know, here I am. I'm talking about math, statistics, probabilities, not the kind of stuff that makes you know, that the people out there trying to sell a million courses are talking about. And that's a good reason, is why they don't do it, because they know most people don't want to hear that. Well, most people are losing money. Most people are losing money. So if you want to make money, you got to be a professional trader, and that means you got to dig into these kind of details. And that's it. I'm not going to soft quit it for you. That's the way it is. So here at Top Dog Trading, our goal is not to sell the most courses. Our goal is to create the most profitable traders. And therefore, I just got to tell you the truth, even when people don't want to hear it. That's fine with me. That's fine. I got many sources of income, multiple streams of income. See, this is where multiple streams of income come in really handy. You're not desperate for any one of them. You don't need anyone's money. It's a good place to be. That's true security. Okay, my friends, Barry Burns, Top Dog Trading. Have a great rest of the day and happy trades.